Canadian National Railway and Canadian Pacific Kansas City are working to resume operations after a Labour board imposed binding arbitration and ordered employees back to work. CN Rail says it could take longer than a week to return to full service. Meanwhile, Canadian Pacific Kansas City says it anticipates several weeks for the railway to recover, with an additional time for supply chains to stabilize. The federal government is imposing new tariffs on Chinese-made electric vehicles, aluminum and steel. Prime Minister Justin Trudeau announced the policy this morning in Halifax, and he says the tariff rate will be 100% on Chinese-made electric vehicles and 25% on steel and aluminum. The move puts Canada in line with the United States and protects domestic manufacturers. Shares of PDD Holdings are plunging today. There's the stock down by 27% and more. It's the parent company of e-commerce platform Temu, and it posted disappointing results in its latest quarter, with revenue falling short of expectations. PDD says the results are due to a pullback in consumer spending as well as pressure from competitors. The company warns that looking ahead, revenue growth and profitability will likely be affected. Well, U.S. markets are pricing in 200 basis points of rate cuts by next June, following Fed Chair Jerome Powell's more dovish than expected remarks at Jackson Hole last week. But they should be careful what they wish for, says our next guest. He's still bullish on the fourth quarter despite signs of cooling market. Let's go to Bob Iaccino, co-founder and chief market strategist at Path Trading Partners. Bob, thanks a lot for joining us. Lots, as always, to talk about. Let's first of all talk about whether markets are too buoyant, too optimistic on how many cuts the Fed is going to deliver.
Well, I'm not sure if that's the way I'd phrase it, Paul. What I'm trying to say here is that I think the market is expecting these cuts to be nothing but good. And that's because I don't know if they're too buoyant. When you look at the speech that Jerome Powell gave on Friday, he seemed to be pretty positive about the overall economy, yet describing a scenario that might be more aggressive in rate hikes. And that's a hard thing for me to sort of square. When you look at the past where there's been aggressive rate hikes, as I feel Jerome Powell described, that usually has been a precursor for weakening economies and even recessions oftentimes. Now, I don't think that's what Jerome Powell was trying to send to the market in terms of a message, not necessarily the type of message I'm trying to send either. But the market right now has 200 basis points priced in by June. I think by any measure, that's aggressive. And if we get that, if we actually get what the market is pricing in now, which we have to assume that's what stocks are reacting to, that's likely a scenario of economic weakness, because otherwise, why would you do that? Why would you take rates down so low? So based off of that, I don't expect any problems in the fourth quarter. Fourth quarters are just known to be fairly strong, especially in election years here in the U.S. And I don't see any reason that a recovery from what may be an August drop or a September drop wouldn't be strong like it has been historically. But I worry about the first quarter of 2025 if those cuts, I should say, rather materialize.
It sounds like you are, I know you're focused on all the important economic data, but it sounds like you're really underscoring the importance of labor data at this point.
Absolutely. Labor is weakening. The quits rate has been dropping, meaning more consumers are less comfortable quitting with the thought that they may not get another job or as good of another job if they were to quit their current role. So that's early signs of weakness. We've also got weakness in manufacturing PMIs, pretty much everywhere except the UK. So globally, we're seeing that weakness. Now, manufacturing, you may think, well, that doesn't matter as much in the U.S. We're a services economy now, but it's a leading indicator for the business cycle. Now, most other things are pointing toward a stable or even slightly stronger economy. But the labor market and that manufacturing PMI gives me pause. And I wonder if that's why the Fed has set this up the way they have, or even Jerome Powell. Jerome Powell seemed to imply this was his opinion rather than the committee's opinion. We'll see over the next few weeks how some of the other Fed speakers deal with it until we get to the quiet period before the September meeting.
Okay, we've got three stocks here. You're like, they're all consumer stocks. So square that up for me. When you're concerned about the longer-term path of the U.S. economy, you worry about economic weakness. You're worried about the labor market, but you like these three stocks, which are up on our screen right now: Starbucks, Target, and Walmart.
So I'm glad you called me out on that in the kind way you always do, Paul. The reason I like that is because I think the first rate hike, or I'm sorry, rate cut or two, so not used to saying cut yet. The first rate cut or two, consumers are going to absorb that and be very happy about it. So one of the things consumers tend to pull back on are these smaller luxuries like their coffee when they're starting to struggle. So if you see a rate cut and consumers go, okay, finally, we're getting some relief, they're going back to Starbucks in droves, in my opinion. It's one of those small luxuries that isn't going to affect their weekly or monthly budget by that much if they think they're getting more money in their pockets by the basis of a rate cut. Also with Walmart and Target, same kind of a thing. Maybe some smaller purchases they've been putting off, but they're still going to go to the more affordable stores. Starbucks used to be sort of branded a luxury. It's not really that anymore. Target, Walmart are where Target is where the higher end or upper middle class cost conscious consumer shops. And Walmart is where the lower socioeconomic spectrum goes and shops when they're less worried. So I believe both of those stocks will enjoy a lift. Now, Walmart and Target, I want to see more of a pullback. Starbucks, I like today.
What do you think of the CEO change coming at Starbucks? That, by a long shot, has been the most material influence on the share price over the past, over recent times.
So it's strange, Paul. It's kind of above my pay grade to judge a CEO in a new role. And I really don't know why anyone tries to do that. Even if a CEO has been successful in the past, when he goes into a new role in a new business, I'm not sure why it's just assumed that they're going to be just as good there. So that's the kind of thing I always sort of pause and wait for performance before I pass judgment on that. So that's not why I'm buying Starbucks. I'm buying it on the backs of early rate cuts, and those should play out through the fourth quarter, as I'm expecting the whole market to play out well through the fourth quarter. And then I would sort of reassess this, which I'll be on with you guys again before the fourth quarter is up, so we can talk about it then.
And we look forward to that.